Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Good morning, friends. Okay, let's continue with the discussion. In the previous class, we have completed one chapter of your financial management. When we started with FM, we understood that FM comprises of two major parts. One is raising of money, which is technically called financing decision, and second is investment of the money, which is technically called investment decision. In financing, we have learned cost of capital. There are two other parts related to financing, which is on capital structure and something called as your leverages, which we'll touch upon little later. Today, I'm going to start with an area called ratio analysis. In fact, ideally, I should have started with only ratio analysis because this sometimes becomes the base for other chapters. Somewhere in a chapter, you may find a ratio there, and that ratio understanding, that time I would have said when we did cost of capital, we could have come across certain ratios which I wouldn't have explained fully. So let us do now ratio analysis, so that whenever in the next set of chapters we find a ratio, we are able to link it with this chapter and use it. Now let us understand what is ratio. Now ratio is technically linking of two related items. These items could be linked in some logical way. So if at all I am able to find a link between two items, I may put a ratio around it and then try to compare the ratio of today with the next year, ratio of the next year with the next to next year, or ratio of mine with another company. Wherever there is a logical linkage, there is a logical linkage between the two items, you can put in the form of a ratio. In an education industry, we have a ratio called student teacher ratio. This is also a ratio which is measured. So if a school has more students, logically they need to have more teachers, and a parent, whenever they are taking admission for their kid, may ask a ratio called what is the two teacher student ratio or student teacher ratio, whatever name you want to call. Similarly, revenues of a company, number of employees of a company. If at all there's a linkage between revenues and number of employees, I may measure a ratio called revenue per employee. Revenue per employee is a ratio which is normally measured in IT industry. So wherever you are able to find linkage of two numbers, you would want to put a number around it. That number is called ratio. The ratio could be in times, could be in percentage. These are the two normal forms. It could be expressed in times, or it could be expressed in percentage, or it could be expressed as ratio itself, 2:1. So these are the ways ratios are expressed. But the most important part is we are linking two items wherever we are able to find some logic on the item. If somebody says no, there is no logical linkage, I cannot take that as a ratio. Number of students, number of admin person in Bharadwaj Institute, I find a ratio linkage. Maybe I will measure that ratio, that how many students per admin we have. 500 students, 200 students, 100 students. If students increase, maybe I increase the number of admin people. Students decrease, maybe I decrease the number of admin people. Retail sector, they measure something called as sales per square feet. Sales per square feet. More the space, more is the sales. Less the space, less is the sales. This is very prevalent for your supermarkets and others. When you go to a supermarket, more space, more inventory, more variety, more sales. Less space, less variety, less sales. So we measure a ratio called sales per square feet. Similarly, when it comes to our financial statements, we will link P and L item, P and L item. There could be a P and L item and another P and L item. For example, raw material consumed, administration cost. I don't see any linkage. Raw material consumed and administration cost, both are P and L item, but I don't find any linkage between the two. I may not measure them. Then what can be the linked item? Gross profit, sales. Gross profit and sales is a linked item, and that is technically called as what ratio? GP ratio. Gross profit from the P&L, sales from the P&L, link them together. Net profit from the P&L, sales from the P&L, link it together. Direct material cost from P&L, sales from P&L. Direct material as a proportion of sales. Direct material as a, in fact, in costing we used to do this OAR, where we used to link. That is also ratio only. That is also technically a ratio only, where we are finding out if there is any linkage between the two items. We used to absorb over it's there. Same way, I may link and call it as GP ratio, MP ratio. The link could be between a P&L item and another P&L item. I may go ahead and find a link between balance sheet item and balance sheet item. Two balance sheet item may be linked together, where I may want to link the fixed assets with the current asset. If at all there is a linkage, and call it as fixed assets to current asset ratio, current assets to fixed asset ratio, are the one common ratio you may be aware of. Current ratio, current assets to current liabilities, current assets to current liability. So you may link a balance sheet item with another balance sheet item with, again the logic is, if at all there is a logical linkage between the two. If no linkage is there, there's no point in linking them together. Or it can be a link between P&L item and a balance sheet item. One data can come from profit and loss account, one data can come from your balance sheet, and you may want to link them together. This is the third linkage we may do. There can be a link between P&L with P&L, link between balance sheet with balance sheet, or a link between P&L and a balance sheet item. Some of the ratio you could have seen may be called debtors turnover ratio. Debtors turnover is debtors divided by credit sales. Only thing is, P&L is for the year. P&L is for the year. So the numerator is for the year. Denominator is also for one full year. Here, balance sheet is as on date. Numerator as on date. Denominator as on date. Here, P&L is for full year, and balance sheet is only as on date figure. So whenever you have this, here alone average of balance sheet item is taken if available. If available, I will take the average. I will take the average for the balance sheet item. Ratios as such can be customized according to the requirement. It is not some standardized form and all. Somebody, so I used to work in a rating agency. The way we used to calculate a ratio, someone else used to calculate the same ratio, can be little different also. It can be customized according to your requirement. One thing which the general norm says is, if you take one P&L item, one balance sheet item, please take average for the balance sheet item. That is average debtors by credit sale. Average debtors by credit sale. We have a ratio called ROI, return on investment. I used to talk on this on marginal costing, and said I'll explain later. Return on investment, EBIT, the numerator. Denominator can be average investment. Denominator can be average investment. Return on equity, EAES, average. Don't worry about the ratio formula and all. Wherever balance sheet item is there, you need to take a average if available. Reason is, on the last day, my balance sheet figure may get impacted significantly because of some issues which would have happened. Classic example, COVID happened in the month of March. So in that year, if you take the ratio where one P&L and one balance sheet item is linked, you may find the ratios to be very odd. Reason is the balance sheet item, stock would have got inflated, debtors would have got inflated, whereas sales wouldn't have got impacted fully. 11-month normal sale, only 1 month sales would have got impacted. So a P&L and a balance sheet item, when we link, ideal is to take average of the monthly 12 months average, which and all is difficult because I don't have data to do all that. Let us at least take the average of the opening balance sheet value, closing balance sheet value wherever feasible. Best thing to do, take 12 months average, which and all we will not have. 12 months average, 52 weeks average, all that data we don't want to get into it. We will just go with the average of the opening and average of the sorry, average of the closing. This is what the concept says. Okay. Ratio analysis, linking of two items which are connected in some way. Two items could be from P&L, which is an example is GP ratio. Two items can be from balance sheet. Example, current ratio. One item from P&L, one item from balance sheet, which is technically called debtors turnover ratio. An example, take average data of balance sheet item for this. Take the average data of balance sheet item for this wherever feasible. Most of our problems we will not take average. Most we will not be taking average because of lack of information. But wherever feasible, mostly these turnover ratios, debtors turnover, creditors turnover, all that we will take average. But otherwise we will ignore taking average because of the information inadequacy. Any doubts till this? Okay. Now the ratios are classified into multiple category. First one is called, I'm just noting down, but there can be more category also. Liquidity ratio. What is liquidity ratios? Ability to repay the short term liabilities. Ability to repay the short term liabilities. Everything is there in the book. Whatever is there in the book, only I'm writing it here. I'm not teaching anything new. Just that I'm not showing you the screen because you'll then look at the, you also don't look at your book, okay? Be in listen mode only. The purpose of me typing here is I don't want you to look at the screen, okay? Liquidity ratio, which is basically the short term liability, ability to repay that. Lot of times a business could be doing really well, they could be making lot of profits. So for example, I earn good money, instead of keeping that money in savings account or an liquid form, I invested in lot of investments which have a lock in of 5 years or something. Suddenly, if there's an emergency requirement of even 50,000, and if my all investments are long term in nature, I'll not be able to pay 50,000. I'll not be able to pay the amount of even 50,000. I may be having investment of 1 crore also, but 50,000 I may struggle if I don't keep some money in liquid form. Liquid form is what? Cash, or in your bank account balance, or very short term investment. If that is not there, how will I meet my short term liability? So liquidity ratio, short term liability are measure of short term solvency. Solvency is ability to repay your liability. Ability to repay your liability. Bharadwaj Institute profitable, has everything, whatever fees we have collected. We started a batch, fees collected, okay? After the fees is collected, this happens not Bharadwaj, this happens in school or college. They collect money at the beginning of the year. There's no money collected throughout the year most of the times, one time money collection. What they do is they keep them in 1 month FD, 2 month FD, 3 month FD, 4 month FD, 5 month FD. Why? Because every month they have to meet expenses. No income is going to come later. Instead of doing that, what they did, they put that entire money in land and building, plant and machinery. They purchase some extra building. How will you pay your monthly expenses? So the school will not be in a position to even pay salaries if they put the entire money, if they put the entire money in long-term assets. You need to keep money in short-term assets so that you can take care of the short-term liability. Short-term assets, you need to take care of your short-term liability. That is only possible if you manage your short-term solvency better. That is one category of ratio. Second is long-term solvency. It is technically called capital structure are basically the mix between equity and preference, mix between the debt, equity and preference. If you have a very high debt, maybe you may start struggling with long term solvency. Long term solvency means over the longer period is maybe more than a year, you may go under winding up. Classic example, your Anil Ambani companies, the Ambani group which is there, Reliance group. So there is Mukesh Ambani's companies and there are Anil Ambani's companies. The big brother companies are doing well, the other brother is not able to do well. So because of one major reason is he has taken lot of borrowing. So if you have a very high borrowing in the balance sheet, you will start struggling over the long run. You will start struggling over the long run. That is called long term solvency or capital structure ratio. The third category is turnover ratio of the business. What is turnover ratios? How quickly are we rotating the money? Are we rotating the money? What does a retail store do? He buys the stock. His objective is very clear. Sell the stock, buy the next lot. Sell the stock, buy the next lot. Sell the stock, buy the next lot. This is measured in a ratio called stock turnover ratio. Stock turnover ratio. How many times are we able to rotate the money? Are we able to rotate the stock? Now, one classic example, milk business. In a milk business, the stock turnover could be 300 times a year or even 360 times a year. Morning get it, same day sell it, get that money, no credit and all given. Morning take buy the milk, by evening money is collected, or by morning itself money is also collected. Next day give it to supplier, take next day stock, next day sell it, next day sell it, and continuously keep rotating the money. Continuously keep rotating the money. Faster the rotation, more profit you will make. Faster rotation, more profit you are going to make. That is called turnover ratio. You may want to measure the effectiveness of stock turnover, debtors turnover, your fixed assets turnover. A lot of ratios are there. All that we'll see later. So third is turnover ratio, which measure how effectively are we rotating the money. Profitability ratio, sales related. What is sales related? Is denominator is sales. Sales related, very simple. Denominator is sales. Example, GP ratio, GP by sales. NP ratio, NP by sales. Operating profit ratio, operating profit by sales. So the denominator we use here is sales. Asset related or investment related. There are certain profitability ratio where the denominator is assets, investment, capital employed. That is another category of ratio. You will understand about this, all of this as we proceed. So one is sales related, second is in the denominator. Instead of sales, you may bring in total assets, you may bring in capital employed, you may bring in equity shareholders money, you may bring in preference shareholders money in the denominator. In the denominator, instead of using sales, we are going to use something else. That is another category of ratio. Again, one P&L, one balance sheet will be linked in this category. So this is fifth category of ratio. Fifth category is asset related or investment related. Some ratio we calculate from owner point of view. Owner is shareholders point of view, primarily equity shareholders point of view. We have certain ratio called earnings per share, dividend per share, payout ratio, retention ratio. All these terms I did discuss when I discussed the cost of capital. But ideally, if I had done this and then went there, it would have been more clearer. There can be other category also, but primarily this. One is your short-term solvency. Second is your long-term solvency, sales, return on assets, investment, owner's point of view. This we have seen. Apart from, okay, turnover ratio we have seen. Something related to market will be there, which is the EPS, DPS will again come there. I'll discuss that as we proceed. And something on coverage ratio. What is coverage also? We'll discuss as we proceed. But these are the category of ratios we are going to see. In that, the first category we are going to start is short-term solvency ratio. Short-term solvency is ability to repay the short-term liabilities of the company. We'll go one by one. Short-term solvency ratio. Nothing for you to note down. I'm not going to teach it. Only thing is I don't want to show the screen to you. Reason is two reasons. One, you're already aware of this area to some extent, so you can maybe recollect your understanding. Second, when I show, your focus only shifts to screen rather than the explanation. Let's start. The first ratio is current ratio. You are aware. What is the formula? Current assets by current. Everyone participate. Okay. Current liability. What is the meaning of current assets? Which are convertible into cash within a period of 1 year. Within 12 months, if you can convert, that is called current asset. What is current liability? Which are repayable again within 12 months. Within 12 months, current assets and current liability. Is there any ideal current ratio? There's a usual interview question which I have asked many candidates. Practical world, there's no ideal current ratio. There's nothing like an ideal current ratio. I've asked many candidates this question. Your institute study material does talk about 2:1, but there's nothing like ideal current ratio. I'll give you example. There's a company HUL, Hindustan Unilever Limited. They're into FMCG products, soap, shampoo, which you use. That company, their current assets will be lower than their current liability. Their current assets will be lower than their current liability. Does that mean they are in trouble? No. Their business is like that. What is their business? They get the manufacturing done. They don't manufacture on their own most of the time. Somebody else will manufacture for them. When somebody else is manufacturing, they're all smaller company. HUL does not pay them very faster. It takes time. It's not that it is delaying payment. It will take 60 days time, 90 days time. So they have good creditors. They don't maintain any inventory. Inventory is maintained by these people. They give it to me. I immediately sell it because it's a fast moving product for me. HUL is not struggling with inventory. Data are also not there very much. Not high data, not high inventory, but a very high creditor. So if you go by technical formula, you may find the ratio to be less than 1 also, but that doesn't mean they are in trouble. So there's a first ratio. There's nothing like an ideal current ratio. Institute study material does talk about an ideal current ratio still. Current assets by current liability. The second ratio we have is quick ratio. Just give me a minute. Quick ratio. Any other name for quick ratio you remember? Liquid ratio. Any other name? If at all you remember. Okay, there's another name called acid test ratio. Quick ratio, liquid ratio, or acid test ratio. What's the formula? Quick assets by current liability. Quick assets by current liability. Don't focus on noting down anything. If at all something new is there, let me complete and then see. I don't think I'll explain anything new. There's some new points, I'll tell you to note it down. Quick assets by current liability. What is quick assets? Current assets minus stock minus prepaid expenses. There's a reason for deducting both, but there are some business where stock can even be a quick asset. Example, gold business. If I'm running a gold business, if at all I'm in trouble, I can liquidate the gold the same minute. I can liquidate the gold the same minute. Gold is very much liquid. If I'm not able to sell that jewel, I will crush the jewel, take the pure gold out of it and sell the pure gold. It is very much possible for me to sell the gold. But as a formula, stock is to be subtracted, prepaid expenses is to be subtracted. Why should I subtract prepaid expenses? Why? Okay. Okay. So perfect. So for example, I pay for my internet service, a 1 year advance I have paid. In the March balance sheet, 10-month prepaid is there. I cannot get any cash out of this 10-month prepaid money. Assuming on March 31 or April first week, I have a lot of trouble. I go back to that internet company and tell, please pay me back this money. They'll not pay. Most of the time, you'll not get back the money. So prepaid expense is to be subtracted. This is the second ratio. which is your quick assets divided by current liability. Quick assets divided by current liability. It is called net working capital. Net working capital. What is net working capital? Current assets minus current OR or operating current assets minus operating current. Second formula is what we'll mostly be using. If at all there's a difference, some of the current assets and current liability are not related to the operations of the company. What is operation? Bharadwaj Institute provides classes. With the classes, we may have some debtors. There could be some expenses payable. Other than that, I took a loan. I took a loan. Loan is related to financing operation, or loan is related to financing activity and not related to the operating activity of the business. So when you calculate net working capital, one concept of finance is that in the current liability, you can remove short-term loans. In the current liability, you can remove what? Short-term loans. Similarly, in the current asset, you can remove short-term investments if what you have done. If you have done any short-term investments, which very rare, but this is a concept of finance. The finance concept is operation related assets and operation related liability. Operation related assets and operation related liabilities are to be considered in the calculation. You should only consider your operation related assets and operation related liability, not others. Any doubts in this? Clear? Okay. Absolute liquidity ratio. I don't remember the number of ratio. I'm just noting down whatever I comes to my mind. If there's something extra, I'll explain in some time. Absolute liquidity ratio. Now, like we have quick assets and current liability, they say quick asset may also have certain item which could not be readily convertible. Example, debtor and other things. So, absolute liquidity ratio says cash in hand, which is cash only, cash at bank plus short term investment. If you have done accounting, there would have been a definition in accounting standard 3 for cash and cash equivalent. That is your numerator. Cash and cash equivalent. Cash and cash equivalent. Basically, like cash divided, I think, again by current liability. Some of these ratios formula can be altered according to the requirement. Okay, divided by current liability, cash in hand, cash at bank plus what, short term investments divided by current liability. This is the another category of ratio. Obviously current ratio could be 2:1, quick ratio could be 1.5:1. This could be even lower because current ratio includes everything. Quick assets ignores certain current assets. This ignores a lot of current asset. This ignores a lot of current asset. Then basic defense interval. Now I used to tell many of my students this is not a very critical ratio, but there in ICAI study material in the January exam they asked a question on this. They ended up asking a question on basic defense interval also. So there's nothing like important, unimportant as far as the subject is concerned. Anything can come from ICAI study mat. So basic defense interval is cash in hand, cash at bank, short term investment plus something else. Okay, basically what basic defense interval is saying, going back to COVID times, when COVID happened, suddenly my cash flow stopped in the business. What is cash flow stopping? I'm not able to sell product. If I don't sell product, how will I collect money? So what basic defense interval says is, in case you cannot have any more sales is not there, how many days can you survive? How many days can you survive? What is how many days? Cash in hand, cash at bank, short term investment, receivable. This is also doubtful. Okay, doubtful in the sense during COVID collecting this was also doubtful. Collecting this was also doubtful. Divided by daily expenses, daily operating expenses. If my daily expense is 20 lakh rupees and I have cash, all this put together 200 lakh, next 10 days I can survive. Next 10 days I can survive. Beyond this, I am in trouble. Beyond 10-day period, I am in trouble. 10 days I can survive during the COVID time, provided no extra inflows are coming in the form of sales. Receivable has to be collected. Receivable also not collected, then your 10 days can further go down. Then the 10-day period can further go down. Let us now understand this with the book quickly. Current ratio, current assets by current liability, quick assets by current liability, cash and cash equivalent by current liability, cash equivalent receivables by daily expenses. This is the purposes to take loan from the bank. So bank will give loan only for your operations. Bank can't give loan for your investment purpose or for your financing purpose. What is investment purposes? You want to take a loan from the bank so that you can make short term investment. No, bank will say operating current assets, operating current liability from the operation related asset. Because if you have any short term loan, if you have any short term loan, don't consider that in the current liability. Don't consider that in the current liability. Current assets minus the current liability. This is chapter 9, where you'll understand how we take loan, what loan we take, all that we'll understand there. This is part of chapter 9. Any doubts on this? Able to understand this? Okay. In this daily expenses, COGS, what is COGS is? In your cost sheet you would have learned, or in the trading account, everything is COGS. Add selling and admin expense, deduct if at all any depreciation and non-cash expense if they are part of these two items. Deduction only if they are part of. If somebody says depreciation is part of COGS, obviously deducted. Depreciation is part of COGS, obviously deducted. Any doubts on this? I go to the second category of ratios. Long term solvency ratio. Let's understand certain terms first. Equity capital 1000, reserves and surplus 500, preference 2000, long term loans 1000, current liability 1000, fixed assets 2000, current assets 4600. Give me a minute. P and L debit balance 100. The balance sheet should tally 1500, 3500, 4000, 5500. Okay, so this is the balance sheet of the company. Now I want to measure something called as long term solvency. What is long term solvency? Is ability to repay the long term liabilities of the company. So the long term liabilities here are: preference is a liability, long term loan is also a liability, equity is also a liability, but we don't pay that, we don't repay kind of equity. So my ability to repay the preference and ability to repay the long term loan I want to measure. Before we start, we need to define two things. One, there's a term called equity. Second, there's a term called debt. Okay, three four terms are there. Third, there's a term called capital employed. In fact, first, capital employed. What is capital employed? Is long term money, long term money in the business. What is capital? The cost of capital chapter, we used to calculate cost of debt, cost of equity, cost of retained earnings, cost of preference, all that is part of capital. So long term money, the long term money can be calculated as fixed assets, current assets minus current liability, or you can say total assets minus current liability, or you can say equity, reserves, or equity preference, debt. What is fixed assets plus current assets? 2000 plus 3400 minus 1000. Okay. Or what is total asset? Obviously, in the total asset, don't include P&L debit balance because that is not a real asset. P&L debit balance is not a real asset. So my total asset is 5500. I remove first 100 from there. I remove 100 from that. What is 100? P&L debit balance, and I deduct current liability. Or equity capital, reserves. From reserves, remove the P&L debit balance. Remove the P&L debit balance from the reserve. Remove the P&L debit balance from the reserve. Add preference, add long term loan, all will give same answer. 2000 plus 3400 minus 1000. Fixed assets, current asset minus current liability. If I do that, I get 5400. Or if, sorry, 4400. Or total assets minus the P&L debit balance minus the current liability. Basically, you have to get to this side. To get to this side, you can take the other side and remove current liability, or take this side as it is. The one route is called liability side route, one route is called asset side route. Which route will I use? I don't know. I may use either of the routes. Okay. Sometimes I may use a liability side route, sometimes I may use a asset side route. Asset side route or a liability side route. Total of all assets, obviously remove the fictitious one and deduct the current liability. Or do fixed assets. If investment is there, investment also to be added in the formula. Okay. Investment is part of current assets or maybe part of long term assets, whatever way. Add up all the assets, all good assets. Okay. P&L debit balance is not an asset. P&L debit. Some authors are of the view goodwill also to be removed. Goodwill is also not part of the real assets of the company. So it all depends on whatever is the real asset. Add everything, deduct current liability. Now, this 4400 comprises of what is what? This capital structure ratio, or are the long term solvency ratio measures. The capital structure ratio are long term solvency ratio measure. First, any doubts on what is capital employed? Add up all the assets, remove the current liability, or add up all the liabilities without the current liability. Add up all the liabilities without the, or all assets minus current liability, all liabilities minus current liability. I can't say, I don't want to say all liability minus current liability, but technically these are the two formulae. All assets minus the current liability, or all liabilities minus the current liability. Obvious thing is to eliminate this. Ideally, I don't want to write it here. I wanted to write it this way. Minus 100. Minus 100 and remove it from the asset side. This is what the formula says. Logical approach is to remove it from some place. Where do you want to remove it? All depends on how we do the calculation. Now, after this is calculated, we calculate debt ratio. What is debt ratios? Debt divided by capital employed. What is the debt as part of the capital employed? What is capital employed? We have calculated. What is debt? 1000. 1000 on 4400. 1000 on 4400. Debt ratio means what? Debt divided by capital employed. In that capital employed, what is the proportion of the debt? Second ratio. Equity ratio means equity by capital employed. What is equity as the proportion? These ratios maybe you would have seen, you would have forgotten, but these are something like new. The earlier one was very simple for us. This ratio I'm spending a little bit more time. Okay. Equity ratio is what? Equity divided by capital employed. Equity means equity share capital, reserves. Preference can also be part of equity. It depends in the practical world. Okay. Preference, that's an assumption. Preference, many a times in the practical world, there is no preference capital at all. If it is there, it will either be more like equity or more like debt. What is more like equity? There are companies which issue 0.01% preference, compulsorily convertible preference. Compulsorily convertible preference. What rate? 0.01%. See, I want to give you equity share, but I'm not giving you equity today. I'm giving you equity after 5 years. After 5 years and calling it by what name? 0.01%, no dividend. 0.01 is no dividend, compulsorily convertible. Compulsorily convertible. Because equity share, you don't pay dividend. Example, the 0.01% and all are normally issued by the startup. Ola could have issued at some point of time, or your Zomato may be issuing this, Swiggy may be issuing this. All these company, when they got initial capital, they could have gone for 0.01% CCPS, we say, compulsorily convertible preference share. When I am an analyst, I want to analyze the equity ratio. I will add this entire money to the equity capital. I'll add the entire money to the equity capital. Would we have a trouble when we solve problem? Yes, we may have a trouble when we solve problem. We may not be very clear where should I add it. We may not be very clear where should I add it. Assumption, but normally preference is added to which? Equity, for the purpose of what? Equity ratio. Debt ratio plus equity ratio is one time. Debt ratio plus equity ratio is one time. What is debt ratio doing? Out of 4,400, debt is 2,000, equity is 2,400. Debt is 1,000, equity is 3,400. Debt is 400, equity is 4,000. If you have a very high equity ratio, you will have a very low debt ratio. If you have a very high debt ratio, you will have a very low equity ratio. Very high debt ratio can put under trouble a company. Can put a company under trouble. Any doubts on the first one? Debt ratio, equity ratio. Third one is debt equity ratio. As the name indicates, debt divided by equity. Debt divided by equity. There are three meanings for the term debt. All the three will give different answer. Okay. Debt can mean long-term debt. Debt can mean long-term debt as well short-term debt, and debt can mean long-term debt, short-term debt, creditors, outstanding expenses, provision for tax, everything, because they are also liability. They are also liability. Creditor is also like a borrowing. Creditor is also like a borrowing is what this ratio is saying. Okay, three ways. That's why I said ratios has lot of subjectivity. First ratio which I saw is, go back here, debt ratio, debt divided by capital. Nothing for you to look at the screen, nothing for you to look at in the book. Okay, equity ratio, equity divided by capital employed. Total debt by equity. Total debt can be replaced with total outside liability. What is outside liabilities? Any liability other than owner's money. Owner means equity shareholder money. Other than equity shareholder money. Any debt. What is any debt? Creditor, outstanding expenses, bills payable. Consider all of that. Which one do I follow? No clarity. Exam questions, their confusion is very limited. Okay, they may not have so much information itself. And what is capital employed? Total assets minus the fictitious asset. Fictitious is your P and L debit balance minus what? Current liability are equity share capital, reserves, preference share capital, long term debt minus the fictitious asset. Whatever I've explained to you, I'm now showing it in the screen. Okay, I explained with numbers, this is without numbers. What is equity? Equity share capital plus reserves minus fictitious asset. How is preference treated in ratio? Consider it as part of equity or debt in the above formula. Consider it as part of what? Equity or debt. Mostly I'll treat it as part of equity. Mostly treated as part of equity. Any doubts till this? Any doubts on this? I'll explain again. What we are doing in this ratios, we are seeing how the balance sheet is structured. A simple balance sheet format is this. Fixed asset is there, current asset is there, rarely P and L debit balance could be there, current liability is there, all this is there. Now, first thing I calculate is capital employed. Participate. What is capital employed? Fixed assets plus current assets minus current liability, or total assets minus current liability, or equity capital, reserves and surplus, preference capital minus the fictitious ones. Once I got that number, I find debt as a proportion of capital employed, equity as a proportion of capital employed. I may also want to do preference as part of capital employed, but that's not our common ratios. That is why preference is either added to what? Debt or equity. Debt or equity, depending on the characteristic. Depending on the characteristic. Third is debt equity ratio, which is debt divided by equity. Fourth is asset ratio. Debt to asset ratio, as the name indicates, debt divided by asset. In this, the debt meaning can be either of the three which I said. It can be long-term debt, can be long-term plus short-term, can be long-term plus short-term plus creditor plus all of this. Okay. Then we have proprietary ratio. The term proprietor means owner. Proprietary ratio is going to measure owner money as a proportion of something. Owner money as a proportion of something. So proprietary ratio is equal to owner money divided by total assets. This is divided by total asset. I'll repeat again. Debt ratio, equity ratio, debt by capital employed, equity ratio, equity by capital employed. Debt to asset ratio, proprietary ratio, debt by total assets, equity plus preference. Preference may get added there. Mostly gets added in the proprietary ratio. Okay. Equity plus preference divided by total asset. Best exam problem without preference. I don't want that confusion itself. Okay. Preference there, confusion may come. Confusion may come in exam. Where do I add? I can't give you proper answer, but most of the times I'll add it to equity. Okay. So next category was this assets ratio, which is what? Total debt divided by total asset. Ideally, I should have clubbed it here. Equity and preference divided by total asset. One ratio which is still pending, which I need to discuss. Okay. So I'll discuss again. Debt by capital employed, equity by capital employed, debt by total assets, equity by total assets, debt by equity. Debt by equity. What is capital employed? There's an asset side route, there's a liability side route. Asset side route, fixed assets plus current assets are total assets minus obviously the fictitious one. See, if you do fixed assets plus total asset and that P&L debit balance is not there in the total, you can't subtract now. Okay. In the total asset, if it's there, one exam question they said total assets without the fictitious asset. Now you can't say I will subtract more. It is already not there in the total. How will you subtract it? If it's there in the total, normally somebody says total asset 5,000. It includes even the fictitious asset. But if it's specifically mentioned, total asset does not include fictitious asset, what are we subtracting? So total assets minus the fictitious minus the current liability are equity, reserves and surplus, preference, debt, whatever it is, minus the current liability, What is equity? Equity capital plus reserves minus fictitious asset. Preference will always be added to equity for proprietary ratio. Other place you decide what you want to do. One more formula is pending. Okay, that I am yet to discuss. Any doubts till this? Understood? Okay. This ratio we used in one of the question when I did cost of capital question. Capital gearing ratio. That time I said I can't explain it. Capital gearing ratio. The formula of capital gearing ratio is fixed capital by variable capital. This is a real formula. Okay, we don't use this word. Fixed capital by variable capital. What is fixed capital? Is plus preference. Why it is called fixed capital is on this capital your outflow is fixed in nature. The outflow is fixed in nature. Debt 12% interest, preference 10% dividend, preference 10% dividend. I did really well. Can I increase the dividend? No. There are some participating preference. I'm not discussing all that. Okay. If business does really well, can I increase interest? No. Can I decrease interest if business does bad? No. So fixed capital or fixed liability capital divided by equity share capital reserves. Equity share capital and reserve. Why it is called variable capital? Because the outflow on this is not fixed in nature. Business doing bad, don't pay dividends. Don't pay dividend. Business doing really well, pay double dividends also. You can pay double dividends also. So the formula is what? Debt plus preference by equity plus reserve. The real formula is called fixed capital by variable capital. Fixed capital by variable capital. Now maybe this alone you can write other formula if you want to remember it easily. Fixed capital by variable capital. For the capital gearing ratio, preference will always be added to debt. Fixed capital by variable capital. Fixed capital by variable capital. Wherever you see the word equity there, equity includes reserves and surplus. Okay, the term that is what is defined below also. Equity means reserves is part of equity. Unless they specifically use equity capital word, equity will include reserves. Okay, 6 ratios we have seen: debt by capital employed, equity by capital employed, debt by total assets, equity by total assets, debt by equity, debt plus preference by equity. Can there be any other ratio in this? Maybe. They can add a random ratio. They'll give the formula itself. What is random ratio? Preference to debt 2:1. Preference divided by debt is 2:1. If they give a specific ratio, consider that and proceed ahead. Any doubts on this? Can we proceed now? We're done with two category of ratios. I'll move to the third category now. We are done with capital structure ratio. Third category, I'm not even doing anything in the Word document, directly explaining it. Related to sales means sales is the denominator. The numerator can be COGS, which is called COGS ratio. What is COGS is? Your anything part of trading account. All expenses part of trading account are sales minus GP. Sales minus GP is COGS. GP ratio, GP by sales. Operating expenses ratio, operating expenses. What is operating expenses is? Anything part of P&L account, anything not part of trading account, okay, not part of the trading account, part of the P&L account. Or if you go to cost sheet, after COGS you used to have admin expense and selling expense. Operating expenses means it doesn't include interest. Interest is a non-operating expense, not related to operation. Related to operation expense, not related to operation expense. Operating profit means, as the name indicates, what is operating profit? I'll explain. Pre-tax profit, PBT, post-tax profit, net profit by sales, financial expenses, financial expense by sale. There is a word called operating expenses ratio, operating profit ratio, operating ratio. Operating expenses other than COGS expenses. Operating profit, what is that? I'll explain in a minute. Operating ratio means includes all expenses, includes all, which is COGS plus OE. This is the best way to understand. Sales, COGS by sales is called COGS ratio. GP by sales is called GP ratio. Operating expenses by sales is called operating expense ratio. Once you deduct that, you get operating profit, which is also called as EBIT, which is also called EBIT, operating profit by sales. Operating profit by sales, that is operating profit ratio. This and this put together, COGS and OE put together, is called operating ratio. In the practical world, one common place where operating ratio word is used is railways. They'll say Indian Railways is having an operating ratio of 98. This means 100 rupee income, 98 is the expense. 100 rupee income, 98 is the expense, operating ratio, non-operating expenses are there like interest cost. Not this, again we have a ratio called financial expenses ratio, only interest, okay, interest part, financial expenses ratio. PBT by sales is called pre-tax profit ratio. Tax ratio is not there. I can do a tax by sales ratio also if I want. And post-tax profit ratio, net profit margin. Okay. More interested in this format. Sales is 10 lakh. COGS is 6 lakh. GP is 4 lakh. 6 by 10 is called COGS ratio. 4 by 10 is called GP ratio. Admin and selling 3 by 10 is called operating profit ratio. 1 plus 6 is called operating ratio. 1 plus 6 is called operating. Non-operating income expense 1. Income is not there. PBT by sales is called pre-tax profit ratio. Deduct tax 0.5 and PAT 1.5. 1.5 by 10 is called net profit ratio. Any doubts on any of this? Clear? Can we proceed? Okay, this ratio I'm not spending that much time. Denominator is sales. Numerator can be anything. I can add a random ratio called depreciation to sales ratio. There's no ratio like that, but I can add even depreciation to sales ratio. Depreciation is part of operating expenses. It will either be part of COGS or part of admin expense or part of selling expense. Non-operation, what is non-operation? Something which does not come in cost sheet chapter. Something which does not come in cost sheet. Something which does not come in cost sheet are non-operating expenses. Examples, interest expense and all that. Okay, clear? Can we proceed? Fifth category, coverage ratio. Coverage ratio is source of payment divided by what are we paying. Let us understand this. The formula for coverage ratio, source of payment divided by what are we paying. For example, your monthly expenses 10,000. Your monthly expenses 10,000. This is what you are paying. Now your expenses, there's a source for you to make this money. For you, your sources could be your pocket money, plus if at all you're generating some income, if at all you're doing some small work or some miscellaneous work, or when you start working your articleship stipend and other things. So what is the source of paying something divided by what are we paying? For example, for me, my income divided by my expense is my expense coverage ratio. My expense coverage ratio is my income divided by my expenses. My income divided by my expenses. For example, my income is 20,000, expenses 10,000. 2 times I am covered. Higher the coverage ratio, better it is for me. Higher the coverage ratio, better it is for me. Lower coverage ratio, problematic for me. Higher coverage ratio, better for me, because more coverage ratio, more comfortable am I to meet the expense. Example, COGS coverage, we don't have a ratio like that, okay. COGS coverage ratio is equal to sales by COGS, because COGS is paid out of the sales income. COGS is paid out of the sales income. What is the source of paying something divided by what are we paying? This is the usual formula. With this, there are variants I'll introduce. Now, if I go to an income statement looks like this. We start with EBIT. Before EBIT, you have your sales less COGS, gross profit less operating expense, EBIT. From EBIT, we deduct interest, we get EBT, deduct tax, PAT. After earnings after tax, I deduct an item called preference dividend. I deduct an item called preference dividend. Whatever profits I make, first I have to pay preference dividend. I have to pay preference dividend. After this, leftover money is earnings available to equity shareholders. After the preference dividend is paid, whatever leftover money belongs to equity shareholder. After the preference dividend is paid, leftover money is called earnings available to equity shareholders. Earnings available to equity shareholders, that is the leftover money part. Then less equity dividend, retained profits. Retained profits. I earned something. First, I have to pay equity preference dividend. Then I have to pay equity dividend. Then I can have some retention. Now, with this, I will tell you one ratio is called interest coverage ratio. Interest coverage ratio. What is the item above interest in this table? So formula is EBIT by interest. Formula is EBIT by interest. Don't remember the formula. Logic is EBIT by interest. Interest is paid out of the EBIT of the company. Interest is paid out of EBIT of the company. EBIT by interest is called interest coverage ratio. What is above tax? We don't have a ratio like this, but if at all I have tax coverage ratios, EBT by tax. We don't have a ratio like this. What is above preference dividend? EAT by preference dividend is called preference dividend coverage ratio. EAT divided by what? Preference dividend is called what? Preference dividend coverage ratio. What is above equity dividend? EAES by equity dividend is called equity dividend coverage ratio. EAES divided by what? Equity divided by equity dividend. Any doubts on this? Higher coverage ratio better for the organization. So interest coverage ratio EBIT by interest, preference dividend coverage ratio PAT by preference dividend, equity dividend coverage ratio EAES by equity dividend. EAES by equity dividend. Able to understand till this? Three ratios: EBIT by interest, PAT by preference dividend, EAES divided by equity dividend. Maybe you could have come across this earlier, but now the logic of the formula is also explained, which is nothing but source of payment divided by what are we paying. Example, I want to know a very simple ratio. I want to calculate expenses coverage ratio. I want to calculate operating expenses coverage ratio, gross profit divided by operating expenses. Gross profit meets your operating expenses. Higher GP, more ability to pay it. Lower GP, less ability to pay it. Clear? So coverage higher the better. Formula source of paying divided by what are we paying. Now there's one problem in this interest coverage ratio. Interest coverage ratio considers only interest, but when you take a loan, you have to pay interest plus principal. Interest plus principal. In the denominator, you have to have what? Interest plus principal. Every month we have to pay principal. That is measured through a ratio called DSCR, debt service coverage ratio. DSCR, debt service coverage ratio. ICAI study material has another ratio called, which I've never seen in practical world, but looking at how exam testing is there, they may test this also. Fixed charges coverage ratio. I have not seen this in the practical world, but ICAI material does have this. Both has same denominator. This has EBIT starting, add back depreciation. Why depreciation is added back? Non-cash item. Non-cash item. Add back what? Depreciation in the calculation, which is a non-cash item. Which is a non-cash item. EBIT plus depreciation divided by interest plus principal. This is not a very good formula. What is a good formula? Start with PAT. Start with PAT. In PAT was interest subtracted? Yes, but the interest is my denominator. So they say to pay the interest, interest should be added back to PAT. To pay the interest, interest should be added back to the PAT and also add back depreciation. Will both formula give different answer? Yes. Would it be very close? Yes, very close also. But both will give different answer. Logical formula is the above one. PAT plus interest plus depreciation. EBIT plus depreciation problem is taxes is not considered in the calculation. I can't say to government that I have to repay loan, I won't pay taxes. Taxes have to be paid. See, for interest coverage ratio, EBIT by interest is logical, because if you don't have EBIT, you will have lower coverage, no taxes. Taxes will not be there. If EBIT is less, taxes itself will go down. But debt service coverage ratios on your profit after tax, you need to see whether you can pay the installment or not. On your profit after tax, you can't tell government that I have to repay loan, I will not pay you tax. That is not possible. So PAT plus what? Interest plus depreciation divided by interest plus principal divided by interest plus principal. PAT plus interest plus depreciation divided by interest plus principal. Very logical formula. Ideally, this is what I should use. Sometime, if you wish, that is ICAI material says, there's another formula called what? Fixed charges coverage ratio, which is EBIT plus depreciation divided by interest plus principal. I have added this formula only because your study material is talking about it. I used to work in a rating agency. We have never used this formula. EBIT plus depreciation formula we have never used. We have used DSCR. DSCR is a very commonly used formula. Any doubts in this? Understood? Are these the only coverage ratio we can have? Logically, you can add anything else also, whichever you find a proper connection. Okay, properly logical formula, you please add it. Otherwise, these are the coverage ratio we follow. Any doubts on this? Not sure how much space you have, but in the space left there, please write the format of P and L. In the space left there, how you manage up to you, but write it there only. This is the format of P and L. So we will be seeing this format at other places also, but it's better to write this format. You guys have the AC remote? Write the format. Is that AC is also switched off? Switch on that AC, no? EBIT less interest, EBT less tax, EAT less PD, EAES less equity dividend, retained profits. This is not a very difficult format. I'll be using this extensively in chapter 5. But anyway, we have reached this stage. Let us write this at this stage. How you manage space up to you. EBIT less interest, EBT less tax, EAT less PD, EAES less equity dividend, retained profits or retained earnings. Clear? Can you proceed? Any doubts on this? Done? Can we? Before I go to the question, just give me a minute. I need to discuss one more category and then I go to the question. Any doubts on this? Okay. We have a category called profitability ratio related to return on asset or investment. Return on asset or investment. What is this category of ratio? What are we doing here? Let us understand it. Now, in the balance sheet and in the P&L, we have some profit figures in P&L, and in balance sheet we have certain asset figure or investment figure. In P&L, I can have GP, which I don't use for any formula. I have operating profit, the format which you have written, which is called EBIT. I may use this for some formula, okay? Operating profit. Then we have PBT, which we may use for some formula. Then we have net profit, which we are going to use for some formula. Net profit. One is gross profit. Second is operating profit, which I don't, gross profit I don't use anywhere. Operating profit I use. PBT may be used. PAT may be used. And last is EAES. Last is EAES. I take any of this and give a denominator from the balance sheet. What is the denominator from the balance sheet? One you can take is equity, not equity share capital, equity. So one formula we have is equity, guys, get this, EAES divided by equity. What is equity? Equity share capital plus reserves and surplus minus the fictitious asset. Take the EAES from the P&L and divide it by equity. Take the EAES, because EAES belongs to whom? Equity, guys. EAES belongs to equity, guys, and divide this by what? Equity. Divide this by equity. EAES divided by equity, and that is called ROE, return on equity. Return on equity. EAES from where? From the P&L. Equity from where? Balance sheet, and call it as ROE. Is it one P&L, one balance sheet item here? Yes. So if possible, take the average. If possible, very rare, okay, very rare. Possible, take the average, okay. This is first formula, EAES divided by equity. Then I have another formula where I take denominator as total asset. Take the denominator as total assets. Take the denominator as total asset. And the third one which I can take denominator is capital employed. Capital employed means we saw that formula, no? The denominator can be capital employed. Does capital employed include debt? Does it include preference? Does it include equity? Yes. So for capital employed, my numerator is EBIT. Why EBIT? Because in EBIT, interest is not subtracted. Because see, EAES means money belonging to equity shareholder. EBIT means money belonging to debt, equity, and preference shareholder. Money belonging to whom? Debt, guys, equity, guys, and preference. So ROCE, other name is called ROI. Investment means not the investment side of the balance sheet, okay? Not the investment side of the balance sheet. ROI means capital employed. Capital employed. This can use EBIT divided by capital employed, or EBIT into 1 minus tax. EBIT into 1 minus tax. In the EBIT, interest not subtracted. Happy. Tax not subtracted. That is wrong. Tax should at least be subtracted. Balance only will go to whom? Debt, guys, equity, guys, and preference, guys. Balance will only go to debt, guys, equity, guys, and preference, guys. Tax should ideally be subtracted. So EBIT into 1 minus tax rate. EBIT into 1 minus tax rate. Divide by whom? Debt, guys, equity, guys, and preference, guys. Debt, guys, equity, guys, and preference, guys. The second thing is, one is ROE, EAS by equity. ROI or ROCE, pre-tax, EBIT by capital employed. Post-tax is what? EBIT into 1 minus tax rate divided again by what? capital employed. Any doubts on this? Okay, I thought this doubt will come. Okay. So when I do my calculation, EBIT, as he said, I do interest, tax is paid on EBT. What concept says is interest is not to be subtracted. You do EBIT into 1 minus T. You get this ROCE. Compare this with KO. What is KO? Earlier chapter, cost of capital. In the cost of capital, cost of debt is also interest into 1 minus tax. So KO is down, ROC is also down. KO is down because why ROC is down? Because tax is not on EBIT, tax is on EBT. If you do it on EBIT, ROC will go down, which is okay. That is what has to be done. Because see, the logic of ROC formula is why we do EBIT by capital, EBIT into 1 minus taxes. I don't know whether I will have borrowing or I will have preference or I will have equity. It could be very much possible that 100% equity company is there. It could be a 100% equity company, or it could be a 20% equity, 20% debt, 80% whatever. The combination I don't know. So ROC says I am not bothered what is the combination. I am not bothered what is the combination. You first calculate the ROC, go to cost of capital chapter, look at the combination, calculate KO. Ideal situation, ROC should be greater than KO. ROC should be greater than KO. If not, you will not be able to meet your commitments. You will not be able to meet the commitments. Able to understand this? So it is on EBIT into 1 minus tax rate. Third formula is they are saying take the denominator as total asset. Take the denominator as total asset. The numerator can be little complicated. What ICAI follows is again EBIT or EBIT into 1 minus tax rate divided by total asset. Alternative ways PBT or PAT. PBT or PAT. I'll explain again. From the P&L, I have one gross profit which I don't take. Okay, I don't take gross profit. I have EBIT which is taken, which is also operating profit, which is profit. All are profit only. There's one gross profit, there's one operating profit, one pre-tax profit, one post-tax profit, and one profit after preference dividend, which is called earnings available to equity shareholder. These five I want to divide by some logical linked item. Gross profit, if you want to divide, there is no balance sheet item which can be linked with gross profit. No balance sheet item. P&L item can be linked, which is sales itself. Operating profit means what is my operations generating on the capital employed in the business, on the capital employed in the business or on the total asset employed in the business. The capital employed and total asset will be different figure. Okay, capital employed is different, total asset is different. The denominator can be what? Capital employed. The denominator can also be what? Total asset. The denominator can be total asset. Numerator is same. EBIT or EBIT into 1 minus tax. EBIT or EBIT into 1 minus tax. Return on capital employed, denominator capital employed. Return on asset, denominator asset. Return on fixed asset, denominator fixed asset. Return on current asset, denominator current asset. Return on advances, denominator advances. So whatever is the logical item, return on something, denominator is that. The formula for return is this. What is earned divided by what is invested. For example, FD 1 lakh, interest income 8,000, return is 8%. Return is 8%. Everybody in the practical world want to know what return are we generating. So return is very simple formula. What is earned divided by what is invested. This got tested as a 2-mark question in the latest exam. They got tested this, that first you calculate the return and then do some CAPM analysis. That question and all I'll see later. But the concept which they tested is how do you calculate return? Return is very simple. What is earned divided by what is invested. Investment can be only equity guys money or debt plus equity plus preference or debt plus equity plus preference plus current liability. Debt plus equity plus preference plus current liability. I want to use another formula. Denominator equity plus preference. Denominator is equity plus preference. Equity is also there, preference is also there. Tell me logically what should be the numerator. If denominator is equity plus preference, what can be the logical numerator there? EAT. Because PAT belongs to whom? Equity guys and preference guys together. PAT belongs to whom? Equity guys and preference. One exam they asked, return on proprietor funds. Return on proprietor fund. Denominator they used is what? The equity capital plus preference capital, and numerator they added PAT. They considered PAT. For return on equity, I don't consider PAT because PAT does not belong to equity guy. PAT belongs to equity and preference guy. So we have considered EAES because EAES belongs to equity guy. EAES belongs to whom? Equity guy. EAS belongs to equity guy. Able to understand this? EAES divided by equity is called ROE. No pre-tax, post-tax logic there. ROA, EBIT or EBIT into 1 minus tax divided by asset. Earlier, I used to call this as in fact PBT and PAT, but ICAI has made it very clear that you have to use EBIT and EBIT into 1 minus tax, and ROI or ROC, EBIT into 1 minus tax, denominator capital employed. We have understood the difference between capital employed and total asset some time back. Any doubts on this? Understood this? Can there be anything else? Yes. Return on debt. Return on debt. Interest divided by debt. Interest divided by, because debt guys get only one thing, interest. Debt guys get only one thing, interest divided by debt, or interest into 1 minus tax rate divided by debt, which is nothing but our cost of debt. Cost of debt, return on debt is same. Cost of debt and return on debt is same. Any doubts on this? What is earned divided by what is invested? Any doubts on this? Any doubts on these points? So we have EBIT by capital employed, EBIT into 1 minus tax rate by capital employed, EAES by equity, EBIT by assets, EBIT into 1 minus tax rate by assets. Is there any end to this? I don't see. There can be anything extra also. There can be extra also. Any doubts on this? Understood the logical link? What is earned by what is invested? We are done till this 5 category. 3 categories are still pending. I'll first discuss the 2 categories where I don't have any problem solving, and then I come to turnover ratio where we'll have some problems to be done. The 2 categories in between we'll see later some question. Okay, so the 6th category, owner point of view. Some ratio we calculate from owner. Owner predominantly would be equity shareholder here, but I can calculate from others point of view also, but mostly we are calculating from the equity shareholder point of view. We calculate 4 ratio, all the 4 you are aware of. One is called earnings per share. Earnings per share is what is the profit available per equity share. Profit available per equity share, which is nothing but EAES, earnings available to equity shareholder. Divide that with number of shares. EAES divided by number of shares. This is called earnings per share, which is available to a single equity shareholder. A variant of this is DPS. DPS is dividend per share. From the earnings available to equity shareholder, a part of it I pay to the shareholder. A part of it I pay to the equity shareholder. I'm only discussing about equity shareholder now. So this is called equity dividend divided by number of equity shares. These two, and linking these two is payout ratio. Payout ratio is dividend by EAES OR. DPS by EPS. At a per share level, it is dividend per share divided by earning per share. At a overall level, it is total dividend by total earnings. Total dividend divided by total earnings. At a per share level, it is DPS by EPS. At the overall level is total equity dividend divided by total earnings available to equity shareholder. And with this, we get another formula called retention ratio, 100% minus payout ratio. And we used to use this in the cost of capital chapter called growth rate equal to ROE. How ROE is calculated, we have learned here. into retention ratio. ROE into retention ratio. Any doubts? These are the four ratios we may use from owner point of view. I don't have a problem as of now. I haven't created a basic question, but as we proceed with problem solving, just give me. Okay, as we proceed with problem solving, you will see a lengthier problem. There you may see this adjustment. So these are the four one from owner's point of view. Let's quickly see in the book. EPS, EAES by number of equity share, DPS, equity dividend by number of equity share, payout ratio, EPS by DPS by EPS, and the last one is retention ratio, which is 100% minus the payout ratio. Any doubts on the four category of ratio? Any doubts on this? Clear? Can we proceed? Okay. Next is market point of view. I don't see any big difference between this owner point of view or the market. Market is the share market point of view. More or less, we'll be using these only. One is called price earning multiple. I discussed this earlier also. Price earning multiple, which is nothing but price of a share divided by earning of a share. Price of a share. So the formula is price of share, which is called MPS, divided by earning of share, which is called EPS. Price of share divided by earning of a share. Price of a share divided by earnings of a share, that is called price earning multiple. Okay. Then on dividend, we have certain ratio. First is called dividend rate. Dividend rate. What is dividend rate is what is the dividend and company pays as a proportion of the face value, as a proportion of the face value. Like we have interest rate in the cost of capital chapter, we used to have interest rate, we used to multiply that on face value. Similarly, dividend rate is multiplied with face value. Our dividend rate is DPS by face value into 100. Dividend rate is DPS by face value into 100. Let me complete this part. Dividend payout, which I've written in the top, is DPS by EPS into 100. DPS by EPS into 100. I've already written that in the top. I just want to show together. Dividend yield is DPS by MPS into 100. DPS by MPS into 100. I'll explain all the three together. First is dividend rate. Dividend rate means dividend paid by the organization on the face value of the share. On the face value of the share. Today, if you look at in the practical world, TCS or any company you take, face value will be 10 rupees. Market price could be 3,000, 4,000 rupees. So they will say we are paying a dividend of 200% on face value. 200% on face value looks huge, but no. 200% on face value is 20 rupees on my 3,000 investment. 20 rupees on my 3,000 investment, which is like less than a percentage. Less than a percentage. Dividend can be on face value. So TCS will say 20 on just an imaginary number 10. 20 on 10, 200% is the dividend rate. They will make an announcement saying that we are paying a dividend of 200%. This 20 EPS could be 80 is a 25% payout. 20 on 80 and 20 on 2000 market price, only 1% yield. Only 1% yield means what am I earning in the end? What am I earning? What am I earning in the end? Company may say we are paying 200%, but what reality do I get? Only 1%. Only 1%. Why 1%? Because I can't get the share at 10 rupees. Today, if you want to buy a share of TCS, you may have to pay 2000 rupees, which is the prevailing price in the market. Face value could be only 10 rupees. Face value could be only 10 rupees. So the dividend is divided by face value divided by earnings per share divided by market price per share. All these data practically are available in lot of portals. There's a screener.in which may give all these ratio. But for our understanding exam problem solving, DPS can be on face value, which is called what? Dividend rate. DPS can be on EPS, which is called payout ratio. DPS can be on MPS, which is called dividend yield. I paid 200% on face value, which is 25% of payout, which is equal to 1% of dividend yield. 200% dividend rate, 25% payout, 1% dividend yield, 1% dividend yield, 1% dividend yield. Able to understand this? Clear? Now, only thing is, every formula which I'm giving you, you try to remember. I can't really help it because remembering will not serve any purpose. Understand logic and then proceed. Variant of dividend yield is earning yield. Earning yield is nothing but EPS by MPS into 100. Variant of the dividend yield is called earnings yield. Earnings yield means earnings per share divided by market price per share. Earnings per share divided by market price per share. So if you look at today a company, let's take the example of TCS. Their price is around 2283. Face value is only 1 rupee. The face value of TCS is only 1 rupee. Price is 2283. Dividend yield is 2.80%. 2.80 means on 2283, I approximately get 2.8%, which could be some 60 rupees, some 50-60 rupees. 60 on 1 rupee will be 6000 percentage. 60 rupees on one will be 6000 percentage. 60 rupees on 1 rupee on 1 rupee will be 6000 percentage. So I'll say dividend rate is 6000 percentage. Dividend yield is 2.8% and dividend payout is given here. Dividend payout 81%. Dividend payout is 81%. It is 81% dividend payout. Able to understand the concept? Dividend payout 81, dividend yield is only 2.8%, and the dividend rate could be 6000 percentage approximately. Variant of dividend yield is earnings yield, where you are dividing EPS by MPS. Any doubts till this? Okay. Another point is Tata Consultancy Service market value is 2283. There is a book value. What is book value? Is share capital plus reserves and surplus divided by number of equity share. Share capital, I am the owner. Reserves and surplus, I am the owner. Unfortunately, if at all TCS gets wind up today, the value of the assets, what is share capital plus reserves and surplus? That is nothing but all assets minus all liability other than share capital and reserves and surplus. So balance sheet has an asset value of only 296 rupees. Balance sheet has an asset value of only what? 296 rupees. Balance sheet has an asset value of only 296. What is this 296? Share capital plus reserves and surplus divided by number of equity share. With this, there is a one more formula which can come in the market. Share capital plus reserves and surplus plus the reserves and surplus put together. The value is only 296. Market is giving a value of 2283. Market is giving a value of 2283. What is this formula? The next one is MV to BV multiple. Market value to book value multiple. Market value to book value multiple. Very rarely asked in exam. Very much used in the practical world. What is this formula? MPS by BVPS. What is BVPS? Is book value per share. MPS is market price per share. Market price per share. TCS 2283 divided by 296. 2283 divided by 296. I'll explain again the market point of view formula. One is price earning multiple, self explanatory. Price by EPS. Inverse is earning yield. Inverse is earning yield. Inverse is earning yield. Earning yield formula is what? EPS by MPS. Dividend, three things can happen. One on face value, one on the EPS, one on the MPS, one on the MPS. And there's another formula called MV to BV multiple. Your institute material has one more formula called Q ratio. I'll show it because I can't explain logic for that. That is not at all I've seen in the practical world. But study material has. So my job is just to explain that formula, but not seen in the practical world. Any doubts on this category? Okay, let us see it here now. P multiple MPS by EPS, inverse of P multiple EPS by MPS, inverse of P multiple EPS by MPS, dividend yield DPS by MPS, dividend rate DPS by face value, dividend rate is seen somewhere else, and dividend payout ratio divided by earnings per share, MV to BV, MV divided by BV. The name itself gives the formula, MV divided by BV. BV is share capital, reserves, and obviously fictitious asset divided by number of share. See, TCS balance sheet, if at all winding up happens and I realize exact asset value. And one important thing about TCS is there is a goodwill which is there that is not recorded in the books of accounts. So that is why market is giving 2283. Books has value of only 296. Market is giving 10 times value. There are a lot of intangible assets there. Those are not given any value by the stock market. So 2283 by 296 will give us the MV to BV multiple. Q ratio not seen in the practical world. That's why I did not explain earlier. Market value of equity and liability, that is from your liability side. Get the market value for whatever items are there. You don't have market value, take the book value. We did cost of capital, market value approach, book value approach. Lot of items had market value. Some question had a term loan and other things where I used to say MV and BV same. So market value of equity and liability divided by the value of the asset. What is replacement cost is in case you were to buy those assets today, what will you pay? The last ratio, I don't find big logic in that. Other ratios, I'm perfectly fine to explain it one more time. So we did P multiple. P multiple is what? Price divided by earnings. Inverse is called earning yield. Earnings divided by price. Dividend yield is dividend divided by price. MV to BV multiple. MV divided by BV. Q ratio, liabilities divided by asset. Liability market value. Asset replacement cost. Any doubts till this? Clear? Able to understand this? Can we proceed? This is on related to market. Profitability ratio related to market. Last important category, turnover ratio. Okay. What is turnover ratios? How quickly are we rotating? Are we rotating any asset? How quickly are we rotating the asset? What is rotating the asset? I sell the goods to you, you become a debtor, collect the money, again sell the goods, you again become debtor, collect the money, again sell the goods, again you become debtor, collect, realize, collect, real, sorry, sell, collect, this chain goes on. If I can repeat this cycle 5 times a year, I make so much profit. 10 times a year, I make more profit. 15 times a year, I make more and more profit. How many times are we rotating the various assets? Are we rotating the various assets? The usual formula is turnover ratio is equal to sales divided by the relevant item. What is relevant item? Fixed assets turnover ratio divided by fixed assets. Fixed assets turnover ratio divided by what? Fixed assets. Total asset turnover ratio divided by total assets. Current assets turnover ratio divided by current assets. Working capital turnover ratio divided by working capital. capital employed turnover ratio or capital turnover ratio, divide by capital employed, divide by capital employed, sales by the relevant item, sales by the relevant item, sales by the relevant item. What is relevant item? Fixed assets turnover ratio, divide by fixed asset. Current assets turnover ratio, divide by current asset. Total assets turnover ratio, divide by total asset. Working capital turnover ratio, what is working capital? Current asset minus current liability, divide by working capital. Capital employed turnover ratio, divide by capital employed. I don't use it, but if at all they say equity turnover ratio, we don't see that. But if at all it's there, divide by equity capital, divide by equity capital. Okay. In the turnover ratio, two items may not use sales as the numerator. So till now, whatever I said, sales is the numerator. Exception I'm now coming to. Debtor turnover ratio, denominator debtor. Okay. Debtor turnover ratio, denominator debtor. No doubts in that. I'll come to the numerator in a minute. Okay. Creditor turnover ratio, denominator creditor. Debtor, creditor, inventory. These three may have a different numerator. Debtor will have a numerator called credit sales, not total sales. Debtor will have a numerator called credit sale. Creditor will have a numerator called credit purchases, credit purchases, and inventory will have a numerator called COGS. Inventory will have a numerator called cost of goods sold. Cost of goods sold. Debtor, credit sales, creditor, credit purchases, inventory, cost of goods sold. Everything else total sale. Everything else total sale. Is this the only rule? No. Some question may say fixed assets turnover ratio on COGS. On COGS means do on COGS. I can't say that time you do it on sales. Okay. Some question may say debtor turnover ratio on COGS. Please do it on COGS. If they have told on COGS, I can't tell you to change it. Okay. General rule is everything on sales except three. What are the three? Debtors, creditors, inventory, and all the three are self-explanatory. Debtors is dependent on credit sales and not total sales. So how many times I'm rotating the debtors with the credit sale? Creditors is on credit purchases and inventory is on cost of goods sold. Inventory is on cost of goods sold. Clear? Any doubts till this? Okay. I calculated debtor turnover ratio 6 times. Debtor turnover ratio 6 times. Variant of this is called debtor days. What is debtor days is how many times are we rotating the money is called debtor turnover ratio. In how many days are we collecting the money is called debtor days. We saw this little bit when I did in the costing. There was an area called inventory turnover ratio and inventory days. So debtor turnover ratio 6 times, debtor days is 365 by 6 times. 365 by 6 times or 360 by 6 times, 60 days approximately. In every 60 days, we collect money. I sell the next set of goods, again collect. Every 60 days, one sale and one collection happens, I make a profit. If this rotation of 6 can go to 12, I'll make 12 times profit. 12 can go up to 24, I'll make 24 times profit. Faster the rotation, more is the profit for the organization. More is the profit for the organization. So first is what is turnover ratio? Sales divided by relevant item. Exceptions are there. All of this is there in the book. Now I'll show it from the book. Sales based ratio, sales by relevant item. Relevant item can be total assets, fixed assets, current assets, working capital, capital employed. Don't try to remember so many formulae. Understand the denominator can be total assets, the denominator can be fixed assets, the denominator can be current assets, the denominator can be working capital, the denominator can be capital employed, the denominator can be anything else also. Exception, debtors on credit sale, creditors on credit purchases, inventory on COGS. You can convert this into days if you want. What is days? 365 divided by debtor turnover ratio, creditor turnover ratio, inventory turnover ratio. Clear? In this formula, Is the numerator P&L item or balance sheet item? Denominator balance sheet. This is one category. Mostly will be doing averaging. One category mostly will be doing averaging. One category where we will do average mostly. Other categories I am not that much used, but this category mostly we will do averaging. This is one category. One P&L and balance sheet is linked. This category mostly two P&L or two balance sheet. Mostly two P&L or two balance sheet. Mostly, okay. I'm just talking about mostly. This is also no one P&L, one balance sheet story. This is again P&L and balance sheet story, but rarely we do averaging. Rarely we do averaging because of lack of information. Turnover ratio, you may see me doing averaging most of the time. Most of the time, you will do debtors turnover ratio with average debtor, creditor turnover ratio with average creditor, inventory turnover ratio with average inventory. These three mostly we will do averaging. Able to understand this? Any doubts on this? Okay, I'm giving you 3-4 minutes. Go through concept 1 to concept 9, all category ratio. I'm giving you 3-4 minutes to just go through all the 9 concepts where all the 8 category of ratios are discussed. Okay, let's continue with the ratio analysis. In the previous session, we haven't learned any new concept, but I'll still quickly summarize what we have done till now. We have learned that ratio connects two items which are related in some manner. There should be a relationship. The relationship could be in the form of a investment made, return earned, or it could be that interest paid, the source of paying the interest, which is called coverage ratio, or it could be sales made and the inventory which is rotated, or the debtors which is rotated. Some linkage needs to be there between the two items. We have broadly seen 8 category of ratio. The first one which we saw was short-term solvency ratio, where we had current ratio, current asset by current liability. Quick ratio was quick asset by current liability. Quick asset is current asset minus stock minus prepaid expenses. Absolute liquidity ratio, cash and cash equivalent divided by current liability. Basic difference interval is cash and cash equivalent plus net receivable divided by daily operating expenses, and net working capital is operating current asset minus the operating current liability. Second was long-term solvency, which is called capital structure ratio, where we first learn what is capital employed, which is debt plus equity plus preference, or fixed assets plus current assets minus current liability, or fixed assets plus net working capital, or total assets minus current liability. In all of this, fictitious asset, if at all included somewhere, please subtract it, and debt equity preference, fictitious asset is to be subtracted. We learned debt ratio, which is debt by capital employed, equity ratio, equity by capital employed, debt equity ratio, debt divided by equity, capital gearing ratio, debt plus preference divided by equity shareholders funds. Then we learned proprietary ratio, which is proprietor funds, which is debt plus equity plus preference divided by total assets, and debt to total assets ratio. In all of this, the meaning of debt can be total debt, long term debt, or total debt plus the outside liability, which is called total outside liability. Third category we saw was coverage ratio, which is source of making the payment divided by what are we paying. Interest coverage ratio, EBIT divided by interest. Preference dividend coverage ratio, PAT divided by preference dividend. Equity dividend coverage ratio is equal to EAES divided by equity dividend. Debt service coverage ratio is equal to PAT plus depreciation plus interest divided by interest plus principal, and fixed charges coverage ratio is equal to EBIT plus depreciation divided by interest plus installment. Then we saw ratios in relation to sales. Profitability ratio, GP ratio, GP by sales, your NP ratio, NP by sales, pre-tax profit, PBT by sales, financial expenses ratio, financial expenses by sales, operating ratio, COGS plus operating expenses divided by sales, operating expenses ratio, operating expenses by sales. Then we've learned operating profit ratio, which is EBIT divided by sales. These are all ratios in relation to the sales element. Then we saw return in related to investments or asset. If it's equity is the investment which you made, denominator is equity, numerator is called EAES. If the investment includes debt plus equity plus preference, EBIT or EBIT into 1 minus tax rate. And if total asset is the denominator, again EBIT or EBIT into 1 minus tax rate, which is called return on asset, return on equity, return on investment, or return on capital employed. Then we went ahead and saw something called as turnover ratio, where we are finding out what is the it is sales divided by a relevant item. The relevant item can be fixed asset, which is called fixed asset turnover ratio, denominator fixed asset, denominator current asset, denominator working capital, denominator capital employed, denominator current asset. Any of this can be a denominator total asset. Three items will have a different numerator for the turnover ratio. One is called debtors turnover ratio, where we use credit sales by receivable. The average is to be used. Then we use creditors turnover ratio, which is credit purchases by average payables. And then we saw a ratio called inventory turnover ratio, COGS, divided by average stock. Inverse the formula, do into 365. Inverse the formula into 365 is called debtor days, and into 12 is called debtor months. Once you have the ratio and you want to directly calculate debtor, debtor is equal to credit sales. Debtor is equal to credit sales into number of days by 365 or number of months by 12. We saw certain ratios in relation to market and owner's point of view. One is called EPS, which is EAES divided by number of equity share. DPS, total dividend by number of share. DPS as a proportion of EPS is called payout ratio. 100% minus payout is called retention ratio. Dividend as a percentage of face value is called dividend rate. Dividend as a percentage of market price is called dividend yield. Dividend as a percentage of EPS is called payout ratio. Earnings as a percentage of market price is called earning yield. Price earning multiple is price divided by earning. MB to BB multiple is market value per share divided by book value per share. Book value per share is equal to share capital plus reserves and surplus minus fictitious asset divided by number of equity share. And the last ratio which we saw was a Q ratio, which is related to your market value of equity and liabilities divided by replacement cost of asset. This is what we broadly seen in terms of different ratio. Now we have first learned the basics. Basics is how do we compute ratio. Then we saw specific requirements in the question. Initial set of question, only one category was analyzed. Then we moved ahead and saw something called as multiple ratios in a single problem. What is multiple ratio? We saw one quick ratio coming in, one debt ratio from the second category, one inventory turnover ratio, like that. Now we are going to move ahead and do something called as reverse working problem. What is reverse working problem is, I will give you certain ratio. You have to construct a balance sheet, sometimes balance sheet and P&L, and rarely balance sheet, P&L and a trading account In order to construct the balance sheet, there will be multiple adjustments. I'm just telling you the common ones which will be there. Okay, what is common one? They'll give you working capital in the question. Working capital is current asset minus current liability. They'll also give you current ratio. Use this together and calculate current asset and current liability. We have used it at few places. Second thing they may do is they'll give you quick ratio, current ratio. What is current ratio? Current ratio will say current asset is equal to 3CL, 3 times. Quick asset is equal to 2CL. The difference between this is the stock given in the question, which is equal to 1CL. Stock is equal to 1CL, 0.5CL, 0.25CL. This will give you current liability. Current ratio 2.5CL, maybe quick asset 2CL. The difference is called stock. Prepaid expense and all is ignored. Okay, difference is stock, which is 0.5CL, which is 0.5CL, and with that you get the CL, then you get the CA, then you get the quick asset, whatever you want to do. This is second adjustment. They'll give you stock, they'll give you quick ratio, they'll give you current ratio. I think we have done it in one question, but we may do it now frequently. The stock, quick ratio and current ratio information. Third, GP margin is given. GP is given in the question. Our GP is computed by us. GP margin, GP computation, or sales computation, or COGS computation, and use the stock turnover ratio. Then use the stock turnover ratio. This will give you average stock. If no information, closing stock. No information, closing stock. Or they have given you closing stock, they have given you stock turnover ratio, you calculate the COGS and then go to sales. The combination may give us any information. It may give us GP margin could be computed by us, GP could be computed by us, COGS could be computed by us, inventory could be computed by us, Sales could be computed by S, but this is another combination which we will follow. Fourth one, are these the only adjustment? No, there are a lot. These are one which we may use in multiple question. Okay. Next one is called proprietary ratio. Proprietary ratio will say proprietor funds. Proprietor funds divided by total asset. So I'll ultimately say proprietor fund is equal to 0.75 total asset or something, whatever number we get. Proprietary funds is equal to 0.75 total assets. Then with the proprietary fund, I will prepare a balance sheet which say proprietary fund this side, fixed assets this side, current assets here, current liability here. This is called net working capital. This is called net working capital. Somewhere some information will be there on net working capital, and proprietary fund could be with fixed asset also, could be with fixed asset. So use the combination of proprietary ratio, net working capital, and you may get fixed assets and capital employed. When you do a problem, you'll see this. I haven't done, maybe one question we have done, but still we'll spend time on this later. This is the broad structure. These are the important adjustments which you will see. Is this the only important adjustment? No, there are more. Where are the more one? All of this is here. Okay. Any critical adjustment you will find in these example. Around some 8-9 examples are there. All of these are pulled out from different questions. Pulled out from different question and kept it at one place. So during revision phase, ideal thing for you to do is just to cover the MCQs properly and solve very limited number of questions. Clear? Can we proceed? There's a framework called ROE as per DuPont framework. Let's understand what did DuPont say here. Tell me the formula for ROE. Just give me EAES equity. EAES is otherwise called as PAT. Mostly, okay, otherwise called as PAT. Now a company says, I want to improve return on equity. Bharadwaj Institute is trying to improve the return on equity. One way of improving return on equity is PAT has to go up. PAT going up means I may start charging a higher fees and other things, or equity going down. PAT going up or equity going down, the ratio will improve. Now what DuPont said is, no, let's not see it like this. First see it as PAT by sales. He said, look at the formulas PAT by sales and do sales by asset. Sales by asset and then do asset by equity. If this improves, ROE can improve. PAT by sales, sales is cancelled. Sales by asset, asset cancelled. Asset by equity. He just expanded the formula. What is PAT by sales called? Which ratio is this? Net profit margin. Net profit margin. PAT by sales is called net profit margin. What is sales by asset called? Asset turnover. We don't have asset by equity formula. We have equity by asset. This is opposite of that. Technical name is equity multiplier. Equity multiplier. Now what happens is, if a company wants to improve ROE, first thing they can try is improving the net profit margin, which Bharadwaj Institute says, no, I cannot increase the fees. NP margin depends on the fees charged. Second option is to use the asset more. What is use the asset more? Do 4 batches of classes rather than just running 1 batch or 2 batches. Run 4 batches, run morning batch, evening batch. If I start doing it, my asset is used more. Asset is used more. Asset turnover will improve. Asset turnover, because same asset, sales is going up. So if you can improve asset turnover, ROE can improve. If you can improve asset turnover, ROE can improve. He says ROE has to improve. 3 ways of improving the ROE. First way is net profit margin. I am in an industry where profit margin is difficult to increase. I said, okay, no problem. You can't increase net profit margin, don't increase it. Let's leave it. Net profit margin can't be increased means can't be increased. We are not going to push for increasing the net profit margin. Is there a second option? Yes, second option is there. Sales by asset. What is sales by asset is your asset turnover. Third is a little trickier one. What is a little trickier one is, you can try increasing this. But if you increase this, you are increasing the risk also. What is risk also? My money 20,000. Borrowed money 1 lakh. I can buy 120. Asset by equity will be 6 times. If you increase the borrowing, asset by equity will increase. If you increase the borrowing, asset by equity will increase. But beyond a point, you can't keep increasing this. So if a company wants to improve ROE, he can improve PAT by sales, or improve sales by asset, or improve asset by equity. Same way, he did give another thing also, which is not there in our material, ROA expansion. ROA formula was EBIT by asset. You can break it as EBIT by sales, called net profit, operating profit margin, into sales by asset, asset turnover. You want to improve ROA, improve operating profit margin, or improve asset turnover. Improve operating profit margin or improve asset turnover. Improve asset turnover. Like this, certain ratios you can break it. So ROE as per DuPont framework, net profit margin increase, not able to increase, no problem. Asset turnover increase, not able to increase, no problem. Equity multiplier increase, one of the three, please try increasing. You can't increase all the three, ROE can't increase. ROE can't increase. So if a question says compute ROE and they don't use the word DuPont framework and all, ROE formula is PAT by equity. If they say do as per DuPont framework, then you have to do PAT by sales first, then do sales by asset second, third asset by equity, multiply the three and call it as ROE. Will the number match the original formula? Yes. But if it's an MCQ, original formula is okay. But if they ask in a descriptive question and do ROE as per DuPont framework, or they give certain ratios like this, you have to write PAT by sales separately, sales by asset separately, asset by equity separately. Any doubts on this? Multiplication of 3. Net profit margin, asset turnover, equity multiplier. Something like this can come in exam. What is the ROE? NP margin into asset turnover into, they have given equity by asset. I want asset by equity. So I'll inverse the formula. Net profit margin into asset turnover into asset by equity. They have given equity by asset. They have given equity by asset. We'll call it as what? Asset by equity. We'll call it as asset by equity. Any doubts on this? Clear? That one pending question, let's close it now. Question 18. Limited company books reveal the following information: net income, shareholder equity, asset turnover, net profit margin. You are required to calculate ROE on the DuPont model. ROE on the DuPont model. What is the meaning of net income? Net profit. This is the answer for ROE. Net profit by equity. But instead of writing that, we will write it separately. Net profit divided by equity. 360 divided by 4 lakh, 90% is the answer. But you can't write 90%. You can't write 90%. Can we start? Point number A. NP margin 12%. Point number B. Asset turnover 2.5. Point number C. Asset turnover 2.5. Equity multiplier. Equity multiplier. Equity multiplier. What's the formula for equity multiplier? I said asset by equity. Equity is there. Tell me, how will I get asset? From NP margin, find sales. Asset turnover, find asset. From NP margin, find sales. Is it needed? Yes, I have to present it this way only. There's no other option. Easiest answer, 360 by 4 lakh. Please tell me the sales figure first. Come down, note and then do. sales equal to 360 by 12%. 360 by 12%. 360 by 12%. 30 lakh. 360 divided by 12%. Divided by 12%. Sales is 30 lakhs. 360 by 12%. Asset turnover will give you the asset figure, and then I do asset by equity, and then I multiply the 3. 90% is the answer. I know the ROE number, but presentation has to be done this way only, which is what DuPont framework is saying. Then they say, what will be the revised ROE if NP margin improves to 13, or if asset turnover improves to 2.7, something like that can happen. Your asset is equal to sales divided by the ratio. How much is the asset? 12 lakh divided by how much? 4 lakh. 12 lakh divided by 4 lakh, you get how much? 3 times 12% into 2.5 into 3. 12% into 2.5 into 3. 12% into 2.5 into 3. It looks like more of a formality type of a question, okay? 12% into 2.5 into 3 is the ROE number. Any doubts in this? Into 2.5 into 3. Understood? And normal formula 90%. That's why I said normal formula 90%. DuPont model you will have to do into this item. Normal formula is not needed. You'll have to only DuPont model. Any doubts on this? Clear? With this, the chapter is over. This becomes, any doubts till this? This becomes the base even at CA final, because suddenly you will find a ratio somewhere in AFM, Advanced Financial Management. You may find this ratios even if they want in your accounting also. In accounting also, suddenly in a balance sheet, some of this ratio can come. Not a very tricky one, but basic ratios can come. Any doubts on this? Quick discussion. We understood ratio is linking of two items. They could be from P&L, they could be from balance sheet, one from P&L, one from balance sheet. In that case, where we take average for the balance sheet item. First category we saw was short term solvency ratio. Current ratio formula: current assets by current liability. Quick ratio: quick assets by current liability. Absolute liquidity ratio: cash and cash equivalent divided by current liabilities. Fourth one is your basic defense interval: cash and cash equivalent plus net receivable divided by daily operating expenses. Fifth one is net working capital: current assets minus current liability, the operation related. Then long term solvency, we had a term called capital employed. How is capital employed calculated? Total assets minus current liability, fixed assets plus current asset minus current liability, or debt plus equity plus preference. What's the meaning of equity? Share capital, reserves and surplus minus fictitious asset. Preference may be added, may not be added. What's the formula for debt ratio? Debt by capital employed. Equity ratio, participate. I want everyone to say equity by capital employed. Debt equity ratio, debt by equity. Proprietary ratio, proprietor funds by total assets. Debt to total asset ratio, debt by total asset. Capital gearing ratio, debt plus preference divided by equity plus reserves and surplus. Then we saw profitability ratio related to sales. We had an income statement format. I don't want the ratios. We start with sales, deduct what? COGS, get gross profit, deduct operating expenses, get EBIT or operating profit, deduct interest, EBT, deduct tax, EAT. Okay. In this, COGS by sales is called COGS ratio. GP by sales is called GP margin. Operating expense by sales is called operating expenses to sales. EBIT by sales is called operating profit. COGS plus operating expense by sales is called operating ratio. Interest by sales is called financial expense ratio. PBT by sales is called pre-tax profit ratio. PAT by sales is called net profit margin. Coverage ratio, source of making the payment divided by what is getting paid. Equity dividend coverage ratio formula, EAS by equity dividend. Preference dividend coverage ratio formula, PAT by preference dividend. Interest coverage ratio formula, EBIT by interest. Debt service coverage ratio formula, PAT plus depreciation plus interest divided by interest plus installment. Fixed charges coverage ratio formula, EBIT plus depreciation divided by interest plus installment. Profitability ratio related to return on asset or investment. ROA formula, tell ROA formula, EBIT into 1 minus tax rate divided by total asset. ROI or ROCE formula, EBIT or EBIT into 1 minus tax rate divided by capital employed, ROE formula, EAES divided by amount of equity. Then we saw some ratio from owner's point of view. Earnings per share formula, EAS by number of equity share. Dividend per share formula, total dividend divided by number of equity share. Payout ratio formula, I am getting confused now. Payout ratio formula, dividend per share divided by earnings per share. Retention ratio is 100% minus payout ratio. Dividend can be a percentage of face value, that's called dividend rate. It can be a percentage of market price, that is called dividend yield. It can be a percentage of EPS, that is called dividend payout ratio. That's called dividend payout ratio. Then we saw related to market, where we learnt certain ratio. One is called price earning multiple. What's the formula? MPS by EPS. Earning yield formula, EPS by MPS. Dividend yield formula, DPS by MPS. MV to book value formula, market value by book value per share. How is book value per share calculated? Share capital plus reserves and surplus minus the fictitious asset divided by number of equity share. And there was one ratio which we have not used much. Q ratio is equal to market value of equity and liability divided by replacement cost of assets. Then we have turnover ratio, which measures how quickly are we rotating the money. The basic formula is sales divided by relevant item. The relevant item can be fixed asset turnover ratio, current asset turnover ratio, working capital turnover ratio. And three ratios alone, sales is not used. Debtor turnover ratio, what do we use? Credit sale. Creditor turnover ratio, credit purchases. Inventory turnover ratio, COGS. Clear? Any doubts? This can be converted into days. If you have the ratio 365 by the ratio, you don't have the ratio calculated, inverse the formula and do into 365 or into 12. Using the ratio, you want to calculate debtor. If they given times, sales divided by the number of times. If they given days, sales into number of days by 365. Or you use the formula and then do it. And we lastly learned DuPont framework, which says ROE is equal to PAT by sales by asset by equity. PAT by sales is called net profit margin. Sales by asset is called asset turnover ratio, and the last part is called equity multiplier. Any doubts on this? Able to understand this? Again, my request remains the same. Read the concept book multiple times. Solving question is not going to help beyond a stage unless you are clear on the concept. When I ask you a ratio, no thinking. Logically, you should thought should flow and you should give me the number. Any doubts on this? Done? Clear? Let's take a break now.